Hello everyone. Um, Welcome to our new weekly video. Today we'll solve one financial planning problem. So you can see the first question is what is the implied level of assets at the end of 2023? So we have to find out the ending asset of this practice question. Okay. So we can do it in Excel sheet, and if you follow this video, you will have the idea how you can reach the ending assets value. Okay. So for calculating ending asset, you have given some information here, which is related to average assets and sales. So from here, we can easily calculate the average asset value, and then we can go to the total asset, and thus we can get the ending asset value here. Okay, so the sales value is 1500, and in the question, you can see there is a 10% increase in sales. So our sales is 1500, and there is a 10% increase in sales. So we just increase 10% here, thus we have our new sales value 1650, right? And the ratio of ratio is 40%, which is 0.4. We know that average asset uh, ratio, like sales turnover, is uh, sales over average asset, right? So you can see if we have the sales value, we have the ratio, we can easily calculate the average asset, right? So the average asset should be our sales value over the ratio. Thus we can get the average asset here, 4125. This should be our average asset. So if you divide 1600 over 4 average asset, you will get the ratio, the sales turnover. Okay, so to calculate the ending asset, we need the average asset. So if we have average asset, the total asset must be the double of it, right? The average, because when we make it average, we divide it by 2. But now we want the total asset, so we multiply it by 2, and thus we have our total asset here, 8250. So what was the beginning asset? For the beginning asset, we have to go back for the previous period. So if this is for 2023, so for the beginning asset, we can consider the ending asset of 2022 as a beginning asset of 2023, right? So let's see where the beginning asset for on 2022 ending asset, right? So the ending asset was 390 for 2022. We can see the 2022, the asset was 390. So this 3900 is basically the beginning asset for 2023, and the difference of total asset and beginning asset will give you the value of ending asset. Okay, so this amount is in thousand, so 4350 thousand will be the ending asset for 2023. Okay, so the tricky part here, you have to adjust the sales with the 10% increase, and the ratio you need to find out the average asset, and then just the simple calculation from the total asset, you just deduct the beginning asset to get the ending asset of 2023, and the beginning asset of 2023 is equal to the ending asset of 2022, similar to like the ending asset of 2023 will be the beginning asset for the 2024. Okay, all right, now let's move to the next question. If the company pays 50% of net income as dividend, and how much capital we need, right? So basically, we have to start with the sales here again, because we have already the new sales uh, with the 10% increase. We can just plug the value here. We are not calculating again. And the cost is also, there is a 10% increase in case of cost. You can see here there is a 10% increase in sales and cost in 2023. So the cost of value is 11 to 5. Let's put 11 to 5, the original cost, and then our new cost should be the in 10% increase value. So we just increase value, and we have 1237.5 as our new cost. So if you have sales, you have new cost, you have other expense, you can easily get the pre-tax profit, right? So interest is also given to you. Let's see, interest is 50. So your interest is here 50. So pre-tax profit you easily can calculate from here, sales minus your new cost minus your interest. You can get your pre-tax profit for this year 362.5, and the tax rate is 40%. So we can get the value pre-tax profit and we adjust the tax rate. So we have 145 for the tax. Thus the net income after tax should be the pre-tax profit. You adjust the tax value, and this one is your net income after tax. Okay. So now after tax, you are paying dividend. You are paying 50% of your dividend. So your net income 217.5, and you are giving 50% of your dividend 108.5. Thus you have the return earning should be your net income, and you already paid the dividend. Thus you have 108.5 is okay. All right. So here now we can um, net income minus your payment of dividend. So your return earning should be 108.75. You have the earning on your hand now 108. But what is the increase in asset? So we have to find the increase in asset. Um, our ending asset was 4350, right, for the year of 2023, and our beginning asset was 3900. Thus, on this year, the asset increased by like 450, right? So your asset increased 450 and you have return earning 108. Thus, you can get the capital needed. Your increase and you have return earning. Thus, basically, you have this value 341.25 must be raised in the capital markets if there is no, uh, I mean, if debt remains constant with the equity portion only. Okay, you get it? All right, now let's move to the last part of the question. If Drake is unwilling to make an equity issue, what will be the debt rate? This is very straight card at the end of the 2023. There is no equity issue, so we just consider debt, the debt at the end of 21. So at the 2020, the debt was 1000, right? So we just use that debt value. So our debt is 1000, and our total asset here, uh, you can see here 82, our 4350. So our this value should be uh, okay. So and our ending asset is 4350. Thus our debt ratio should be, oh, sorry, do it again. So it should be 1000 over 4350, right? So here you have like 22.98% uh, as your debt ratio for that part. Okay, I hope it will help you a lot to understand the calculation step by step. If you have still question on the solution or any other aspects of this topic, feel free to reach me. Okay. Thank you.